Good morning to everybody. Welcome. This is Stefano Bestetti in Milan, Head of Marketing of ENG Invest. Thank you for joining the conference call ENG Invest Numen Credit Fund Update and Market Outlook. You receive, I hope so, a link where you can download a quick presentation just to support the investment outlook that Filippo will give you. And now, I would like to turn the conference over Mr. Filippo Lanza, Chief Investment Officer of Numen Capital and Portfolio Manager of ENG Invest Numen Credit Fund. Please go ahead, Filippo, and remember the question you received from our investors. Thank you, Filippo.
Hi, thank you, Stefano, and good morning, everybody. Thanks for taking the time to be on this call. We'll be brief and trying to keep it open to as many questions as available from the audience. I hope you have the presentation in front of you. I mean, the first slide with the title, we're trying to be a little bit provocative, as in trying to understand, is 2016 really as bad as a repeat, if not worse, than 2008? And that was the question mark. We think there's a lot of things that should make you very cautious on investors, and maybe is a repeat of 2008. But at the same time, I'm trying to to strike a positive note. If that were the case, then surely we must have a 2009 around the corner after that. And our view is that potentially is coming, and we may actually have an accelerated combinational version of both 2008, 2009 in the next few quarters. I'll move to page 3 just to give you a quick update on the business side and performance and everything else. I think in terms of performance, we are year to date, we're probably about 1.35% net of fees for the UCITS, for the Numen Credit UCITS Fund, the ENG Invest Numen Credit. We in the left-hand corner at the bottom, we put our performance over the last few months, especially compared to the other indexes. We're trying to be as uncorrelated as possible, and if anything, we're trying to ride this weakness, trying to capitalize on it, capitalize on the related volatility and weakness. As you know, we are a true absolute return fund. We have no bias, whether it's long or short, and we're not married to any specific view or position. We're just trying to be flexible, opportunistic, and try, first of all, preserve the capital, and secondly, make a positive return on it. We received a lot of questions from investors in terms of what is your exposure to financial bonds, corporate bonds, how illiquid they are. We can go through over the presentation, but in the right-hand corner on the top, you will see a quick summary of our current position, which is actually being decreased even more now. Between all the financial and corporate bonds, we don't even reach 5% now, so that 5.3 is probably a little bit outdated, and that's a market value of all our financial bonds, all our corporate bonds at 5%. Most of our exposure is through very liquid, either derivatives or equity or other kind of structures we have in the book, but it's super, super liquid. The reason why we reduced that position is because the liquidity in the market is deteriorating more every day, and we're actually quite concerned about it. That 5% is also has to put in the context of what is the notional behind, and the notion is around 10%. So I would say the weighted average price at which we own those securities is around 50%. I'll move to and one last point on the business. Obviously, I mean, most of you probably know because we already have been having conversation with either Stefano or Nikos, but the business is doing very well. We keep on raising money, I think, for both funds. Performance being helpful as well. And I think both the UCITS and the Edge Fund, we're now crossing probably the $1.2 billion of total AUM across the two. I just moved to page 4. Page 4 is a bit of a recap of what we've seen until now in terms of the year to date, in terms of the performance we've seen across different asset classes. Obviously, everybody is focused on equity. Equity is a big driver, is a good barometer of what's happening in the rest across the economies. One thing that I would like to point your attention on is the table of the 10-year yields that we put on the top right-hand corner. If you look at it, what is disturbing to us is that most of the periphery, Greece, Portugal, Spain, and Italy, if you look at their 10 year yields that they pay on their government debt, all of them are actually way above where they used to be in the first month of QE by the European Central Bank. And some of them are actually even higher than where they used to be in December 2014. So a few months before the very kind of speculated and rumored QE. So in the case of Portugal and Greece, that's actually the changes are meaningful. I would say in the case of Portugal, they're more meaningful in terms of percentage, and in the case of Greece, they're very meaningful because the absolute number and the impact that has on funding. What is interesting is that Italy has been like kind of battling to stay in or outside that group of periphery countries that are actually worse off now with QE than before, optically speaking, but now eventually move to that side. Opposite picture, obviously, is on the super risk-free asset. US is actually way lower, irrespective of Fed policy normalization. UK is probably even more outperforming, irrespective of Brexit risk, and we think probably that's of all is the odd one out that requires to be shorted. And away from that, you look at Germany and Japan, and again, those are the ones that perform the best. They are way lower than where they used to be before either the ECB or the Bank of Japan additional monetary stimulus. So that's quite interesting because it tells you there is a growing risk aversion in the market, and there is a growing disillusion with central bank policy, both Japan and Europe and US as well. So the reason why all of this is very interesting for us, very relevant, is because irrespective of your view on fundamentals, there is a very disturbing set of events which is affecting investor confidence. Within there is a diminishing investor confidence compounded by an increasing skepticism around the ability of central banks to deal with the current financial market, and all of that in a context of very fast decreasing liquidity environment. So what we're trying to say with that is that irrespective of fundamentals, the market may actually creating a negative spiral, which is effectively based on wealth reduction, investor confidence decrease, and then forced liquidation or risk management induced reduction in risky assets. Now, if we move to page 5, that's probably the most important page for us, one of the most important pages of the presentation. We're trying to go through, sorry, there was a small glitch here, I'm really sorry. We're trying to go through the relevant facts, the material facts that make 2016 look like 2008 or look different than 2008 or 2011, which are probably the two years that come more frequently during our conversation with investors. One very important aspect is investment banks. Why are we talking about investment banks? Because investment banks are very important for two reasons. Investment banks are the market for most of the asset classes. Whether it's credit or equity, yes, a lot of stuff is through the exchanges, but at the end of the day, the market making, the liquidity, ultimate liquidity provided on most of the asset classes is coming from investment banks. Not only that, but secondly, investment banks also happen to be some of the biggest asset managers out there. And specifically in the past, because it's true only until 2011, probably 2012, investment banks used to be the biggest hedge fund manager or alternative asset manager in the world. So when we look at 2008, 2008 was big disruption, big market crash, but at that time we had 14 investment banks, which had a very unregulated environment around them. They had almost unlimited capital commitment. And some of them, whether it was JP Morgan CIO, whether UBS Principal Finance, they had big internal hedge funds, much bigger than the hedge funds we see right now in the world. And with that, they had a very strong, very deep ability to take down risk and to provide comfort for markets in moments of volatility. Now, if fast forward to 2011, the number of investment banks has gone down, regulation gone up, and a lot of these internal hedge funds have disappeared or been reduced in size. Now, then let's fast forward to now. Where we are now Now we are with only really 10 big investment banks. They all work on an order basis. There is very little capital commitment available from investment banks. Investment banks are very much ruled by risk management procedure now, and probably for a good reason. Partially the regulator asking, partially is business decision. But at the same time, most of the internal big hedge funds have disappeared. There's no UBS principal finance anymore. There's no big dedicated internal proprietary desk or back book kind of desk. There's nothing like that. So that is a big major structural change in the structure of markets. And that's particularly true for corporates, particularly true for credit, not just corporate, but banks and even government bonds. So all this stuff is truly over the counter. Now, the other items we trying to describe, the next four items are all about the investment industry, like the fund industry, if you want. We had this massive growth of ETF. We go from less than $1 trillion to almost $3 trillion in the space of 8 years. And then, of course, hedge fund has been growing, but underperforming the growth we've seen in UCITS. Both in global AUM, but then even more for the alternative AUM of the UCITS space. If you look at all of these, probably the most impressive growth has been UCITS alternative. They moved from 34 billion to 340. And that probably is an underestimation. I'm sure some of you have even higher number than that, than what we put there. Why that's very important? It's very important because whether it's an ETF or a UCITS, investors have the expectation there is a very defined contractual liquidity framework around that. Now, we've seen it very initially last summer with the first ETF on Greek stocks being suspended, that contractual liquidity may actually not be there when you need it. And that's one big issue that we see is there's a big mismatch between the liquidity which is promised to the investor and the liquidity which we think some of these vehicles will be able to have. And I think that's particularly true for the UCITS, where a lot of alternatives actually have been performing over the last few months, like glorified long, levered long. So we're very concerned about that aspect. The other two items are more on the central banks. What happened between 2008 to now, of course, that central banks have been using a lot of ammunition. Now, a lot of people are concerned they may not have that much ammunition left. We're actually quite confident they can do a lot more if they need it. But that's something to keep in mind, that we had 3 months LIBOR moving from almost 3% to negative now, and then dollar LIBOR moving from 1.5 to half of it, 0.6. So that's something else to keep in mind in terms of liquidity and in terms of market. There is a lot less liquidity, additional liquidity that can be produced by central banks, unless central banks start buying themselves assets. And as of now, of course, the concern is we have with central banks, it seems to us they are preferring using negative rates rather than their own balance sheet. But the last item is another one which is very structural, very relevant, and is the rules of the games. And the rules of the games apply specifically to bank and financial institutions. In 2008, 2008 was not that different from the previous 200 or 300 years of financial history. Central banks was effectively viewed as the lender of last resort, full stop. And they had to act, they had to intervene, and they were a willing player. And that was the big call for us to be very long in 2009, because we thought lender of last resort with electronic money can print money very quickly. And that's what we've seen. We've seen it in the US, we've seen in the UK, we've seen in Europe, we've seen in Japan. What changed from there to 2011 was already a big difference. Yeah, all of a sudden people were unhappy, especially in Europe, politically to kind of bail out banks or countries. And we put it there. We've seen some more bailout, but obtorto collo, which means there was not a choice. It was more like a necessity. But in the meantime, Europe, and not just Europe, has been working on the banking union. And then we go back, we go to where we are now, 2016. We have a totally new set of rules, which are the bailing rules, which are pretty much effective globally and specifically in Europe. Now, those rules are draconian. Yeah, is a very, very different set of rules. The new rules basically allow regulators to literally fast track a combination of Chapter 11 and Chapter 7 within a matter of hours. Basically, regulators now allowed, and this is true in Europe, but not just in Europe, to effectively restructure a bank equitize a bank, split in a good or bad bank, recapitalize the bank at the expense of the investor in a very, very, very fast way. I don't think I can stress enough that what used to take months, if not quarters, in any period of time until now, over the last hundreds of years, now could take 24 hours. And we've seen that already. We've seen with the Italian banks in November, December. We've seen with the Greek banks before. We've seen with the Novo Banco in December, unfortunately, because we were there. They can act very fast. The set of power they got is unprecedented. Unprecedented. Now, those differences, if you look at them, whether it is the kind of, call it investment banking or market makers kind of structure, whether it's in investors, or sorry, the investment fund kind of structure, or the rules of the game about the banking sector, those changes are very, very substantial, very material, and they are probably the biggest discontinuity we've seen in the last few hundred years of financial history. So they cannot be dismissed. And our view is that the market has been very complacent about what has changed and the way that could impact the dynamics of security pricing over the next few months or years, actually. Now, if we move away from page 5, and we dedicated page 6 and 7 basically to what are the concerns, the risks in the market, how we position, how we differ from, like, if you want, the most consensual, least consensual kind of concerns. I think first of the list, of course, has to be China. Everybody is very worried about China. I think since I started looking at China, I've always heard people being very worried and concerned about China. And we've probably been in that camp for a long time. Obviously, what is different now is that we're talking about a bigger size issue, a 24 trillion potential credit bubble. Of course, there's the issue of the reserves, how much of those are real, how much is not, how much is already been invested, how much is liquid, how much is not. There's been a lot of concerns there. Now, we think this is a very consensual concern. And so we are very cautious how to play. We've been playing through the Hong Kong dollar short for some time. We think Hong Kong is truly part of China now. It's got nothing to do with the Hong Kong we think was a British colony a few decades ago. This is totally new, totally different. We think monetary policy in China, if ever get changed, will not be effective if Hong Kong dollar stays fixed at the same level. So that's one of the trade we put on. We think it's a nice, smart, out of money put option. And then alternatively, we've also been doing China CDS. Now, we're very worried about being in a crowded position. So for us, those are marginal trades. We are ready to act if and when things change. But we do not want to go into the renminbi because we think the ability of policymakers in China to fight this trend is still quite high, and we don't see any reason why they would need to devalue immediately, unless, of course, things change, in which case we would have plenty of warnings for that. The other big consensus in the market, which it may be changing now, but not in a meaningful way from what we see, is, of course, oil and emerging markets. Everybody's negative oil. Same people have been calling oil above 100. Now they're calling oil to go to $10, $20. Now, we have no crystal balls. For the little we study demand and supply on oil, it seems actually it's going to improve over the second half of the year. But, of course, it's a big function of global growth, and nobody knows what's going to happen. If we have a proper recession, oil will go down. If we have no recession, but the growth picks up, then probably oil will go up. Now, the reason why we're buying optionality on the way up for oil, and we're trying to be long oil across the fund, is for two reasons. The first one is a market view, which is geopolitical tension has never been as high as now in the Middle East region. Middle East has never been in such a turmoil since probably the 70s. And the chances of a strategic deal with ever kind of growing assertive Russia and Saudi Arabia sort of abandoned by the US to do an oil output cut, we think they're very real. And we think the market is underestimating them. So that's the first reason why we want to have oil exposure that I think is too much of a consensual short. The second reason is for pure risk management reasons. Now, people tend to forget that central banks act mainly because of inflation expectation. Now, you can claim that the inflation target of 2% is totally arbitrary, probably agree. You can claim that they should try to protect the value of money, like Weber, the old ECB director used to say, instead of consumer inflation of 2%, but whatever it is, they follow that. Now, oil is super important for inflation expectation. Now, in the case specifically of Europe, the only reason why ECB launched in 2015 the QE is because inflation expectations were going down, and they were going down because of oil. So if for whatever reason, whether it's an oil output cut or whether it's an increase in confrontation in Middle East, oil goes back to the 40-45 level, it would change the picture in Europe materially. Europe will not be able to launch a QE to help periphery or to help the banks. Europe has been able to launch a QE because of inflation expectation, which are linked, which is pretty much as meant because of oil. Yeah. So oil is something that has to be there as a risk management view, as a risk management position for us, and we think it's very cheap to buy upside optionality across credit, equity, and oil itself. Now, away from that, the other two risks that we keep on hearing, but we think we are much more worried than the market, are liquidity risk and Brexit. Liquidity risk, we already spoke about it. I'm not going to spend more time, but I think liquidity has never been as bad as now. I started investing in '94, and I don't think I remember a single instance where liquidity has not been worse, has ever been worse than this. We are much worse than ever before, and that gap is big and is getting bigger. So on the Brexit side, our view on Brexit is pretty much that it is again, it could potentially be a discontinuity that basically distinguish what happens from now on from what has been happening for the last 50 years. That's big. Within the market is totally underappreciative of that. The last referendum we've seen on an exit has been Greece. And remember, the Greek electors, even if they had all the rational incentives to vote to stay, they voted to get out. Yeah, and only at that point the government made a massive U-turn within a month. Now, in this case, if we have a Brexit, we have no government U-turn. They can't do it. Yeah, we would have a new government and potentially a Scottish referendum within weeks. That is a massive change, and not just for UK, but for Europe. Yeah, if UK leaves, Europe is going to be reshaped very quickly. Yeah, in very different ways from where we currently stand. So that's something we are very, very aware and we position for. Away from that, the next page is page 7. What we're really worried about. I mean, we're worried about specifically, away from the points we raised in the previous slide, we're worried about two things in Europe. One is political drivers. There's a lot of political changes. Some of them are so material, so meaningful that it's actually difficult to stress how important they are. One thing specifically in Europe, away from Brexit, is if you look at the electoral cycles, where it's been Spain, Portugal, Greece and Cyprus, there is a drift towards the kind of the more left and more populist end of the spectrum. And I'm not making a moral judgment or a political judgment. I don't care. I look at the fact that there is per se increasing tension between core and non-core. Yeah. Within that, we're seeing a lot of fiscal slippage because of lack of growth. And then on top of that, you have this kind of additional fuel, which is immigration, which is probably by far the biggest concern for most of the policymakers right now in Europe. Now, all of that together makes confrontation more likely, escalation more likely, and we've seen it in the case of Italy. Like for the first time, we have a PM which is using a tone and involving an array of items and subjects in the confrontation with Europe, which is unprecedented. Yeah, forget about Portugal or Greece. So this is Italy. Yeah, and Italy is a big part of the European Union and Eurozone. So we see a lot of tensions there, and on the political side, and we do not see a specific catalyst to remove them. We don't see a very easy solution to the immigration issue. We don't see a solution in Syria or between Turkey, Syria, and Russia. We don't see anything very easy, very simple coming up from there. On the other side, on the fundamental side, of course, there is a bit of a slowdown in growth. Again, we have no crystal ball. We're not going to try and say we're going to go into recession or we're going to keep on growing out of it. But as of now, the data is pointing to a slowdown. And remember, we are having a slowdown after we had like super low oil levels, super low rates, and a relatively lax fiscal stance. So it's quite worrying that there is something structural behind. Now, how we play, we are, as you know, we've always been like in Greece in the past few months. We are totally out of it because we think there's too much political noise. We're not convinced they're going to be able to cut a deal, and we think Greece could be the scapegoat of the immigration policy. But we're opportunistic on it because at the same time may actually become part of the solution. So it's very binary here, but we're staying out for now, but we're watching. Cyprus, we used to be long. We reduced all of it because we actually duration effectively neutral on it, and we have a curve trade on. But basically, we reduced the outright exposure. Why? Because we think there's a chance actually Cyprus may want to exit the program without a successful review. So that could stop being part of QE. Portugal, very similar, as we said before. No matter what QE is done, Portugal keeps on widening. There is an issue of the government commitment to fiscal policy. There is an issue of growth, and there is an issue with debt. Now, the biggest concern we have with Portugal is technical. I mean, there's only one rating agency, which is DBRS, that keeps them investment grade. They're not investment grade, then there is a real issue because they will be out of QE. And then you're only left with the OMT as an alternative. We do not buy the market consensus that if Portugal is non-investment grade, the ECB will come up with a new waiver. We do not buy that. But if that happens, Portugal is out of QE and there is only OMT left. Spain obviously is a big elephant in the room. There is a chance we're going to go into more elections soon. And that election cycle, if we look at the polls, could be the one that could really tip the point of political balances within Europe from a political point of view. So all of those periphery, we are constructively short in a way that we're very opportunistic, very fast, but we don't see any real exit. And of course, we will adapt and change if and when we see the ECB next in March. Our view on the ECB very quickly is that the more the market recovers before, the least the ECB is going to do, and vice versa. And we think the ECB is going to be very happy to test bail-in rules rather than not. Which move us to the page 8. Page 8 is about the banking union and BRRD. Everybody talks about bail-in. As I said, bail-in, the way it's been structured legally, is the biggest change we've ever seen in financial history. Yeah, banks used to be bailed out, full stop, and they used to be bailed out by the lender of last resort. We had very few instances where it was not the case. Now it's going to be the opposite. Now, what does it mean, bail-in? Bail-in meant until November, I would say, that you basically burn, in case of a capital deficit, you burn from the most subordinated all the way up to potentially the depositor. And depositors get protected if they are inside 100K. Now, that was the view. That was the idea. Now, what happened in December with Novo Banco, and I'll actually skip straight to page 10, is that things were done differently. And I think there was an interesting article, a letter, I think, from a representative on the Financial Times. We actually used the word confiscation. If you look at page 10, we divide the page in two sides. Yeah? On the left-hand side, you see the statement from Bank of Portugal on the 29th of December 2015. And Bank of Portugal said, basically, listen, we need 2 billion. We're going to take those 2 billion from 5 bonds only. We're not going to bail in equity. We're not going to bail in the subordinated. We're not going to bail in all the senior. We're just going to bail in those guys. And then they explain it this way. The selection of the above-mentioned bonds was based on public interest and aimed to safeguard financial stability and ensure compliance with the purposes of the resolution measure applied. Now, why this is very important, very interesting? Because when they did it, and we were part of it, we thought, unfortunately, and that's one bond that a lot of our investors know we've been trying to reduce, and we were planning to cut all of it in the first weeks of January. But the reason why this is very important is that they basically decided to concentrate the recapitalization of the banks only with a very, very narrow group of bondholders. They chose those because they thought they were institutional. And they were institutional in their view because it's written above, those bonds were specifically placed with qualified investors with a minimum denomination of 100,000 euros. So all of a sudden, we introduce a new thing. One thing if you have a bond which is 100,000 euro minimum denomination, and one thing if you have a bond which is a lower minimum denomination. That's a big change, something new. But more importantly, the reason why they did it is because of that public interest and financial stability. So we had a doubt for a long time whether ECB was totally against it, not informed, silently in favor. We didn't know. But we had our answer on the 16th of February 16, when Mario Draghi, which is the president of the ECB, was invited by the European Parliament and went through some Q&A with some MPs. And now it's interesting because, and I read all of it, when they asked, are the BRRD rules inconsistent with financial stability? That was the question posed to Mr. Draghi. And he said, well, the rules themselves provide, with exceptions, where certain liabilities may be exempted when there are systemic financial instability situations. Now, if you go on, then he continues and he said, well, let me be very clear. The financial stability so-called exceptions that I referred to before are in the BRRD. It's not something that I stress or ECB representatives stress. They are part of the BRRD provision, and I was simply recalling those provisions. What it means is that what Bank of Portugal utilized was the current legislation. Now, we knew that, but nobody was expecting they would have applied in that way. Now, what effectively the ECB is saying, that if you have an issue of financial stability, which unsurprisingly exactly the same word that was used in the press release in Portugal, you can effectively distinguish liabilities. What does it mean? It means that if you have a senior bond and an institutional bondholder, you may have a risk, and it's clearly stated in the legislation, that you can get less than par, while the guys below you, which is subordinated retail, actually get par or above you. Now, this is a very, very big, yeah? So, and it's something that the market is not really appreciating, we think. This is the angle we're very focused on and we're very worried about, because if for financial stability we supersede subordination and it becomes an issue whether it's a retail or institutional, then effectively bail-in may actually be used perversely as a wealth tax, progressive wealth tax, which actually gets applied not just to resident but also non-resident institutional investors. That is very, very big, and I cannot stress that enough. Now, if we see another instance where the bail-in get applied along those lines, where for financial stability there is a differentiated treatment, whereas you are a retail or an institutional investor, we may have a very big repricing of the entire capital structure of banks in Europe, and capital markets will be changed by that. Now, if we go back to forward to page 11. This is something that we need to be very, very aware. That's something that is one of the reasons why we are very concerned and why we're not buying any more banks risk until we see a proper clarification of the rules or another testing of the rules. Now, what is interesting about the bail-in and the rules that there are a lot of positive long-term macro implications. Yeah, if bail-in can be used without affecting financial stability, and that's a big question mark I have. But if it cannot be applied that way and banks can be recapitalized, we can see eventually what a lot of commentators have been asking for, which is a much stronger and more solid banking system in Europe. That would, of course, allow a lot of resolution with corporations that are indebted, which then would free them up from debt, because obviously they will be able to, once recapitalized, to do that, but it also would allow a lot more lending. And I think personally that, and we think here with all our analysts, that a lot of the policymakers in Europe are much more interested about that than the specifics of the bail-in and the losses associated with the bail-in for investors. Now, what is the real question is page 12. A lot of investors are asking us, why are you so negative? Why are you so bearish? Is this a buy on dip? Isn't this a fantastic buy on dip? Isn't this another buy on dip, consistently with what we've seen for the last 2 or 3 years? Now, our question is for now, no. No, we're not going to get into it. We're not going to go long. Why? Few things. First of all, is there anyone left to bail us out? Well, central banks really are the only reason why you're going to buy. You're not going to buy because you think growth is coming. You shouldn't be buying because oil is going up, because if oil goes up, central banks are not going to do anything, so they're kind of offsetting one each other. We are not buying because of QE, because of central banks, because we think the marginal impact on QE on underlying economies is diminishing very fast. But the impact on asset volatility is increasing. There's nothing else than saying that the last, I would say, 40, 50 years of macroeconomic theory is actually going to be crashed, and we're going to go back to mercantilism, because that's going to be really the only theory that central banks are using at the moment, this mercantilistic approach. It's all about currency now. Yeah, if you remember ECB at the beginning, a few years ago, they didn't even talk about euro. It's not part of our remit. It's not part of our target, blah, blah. Now they always talk about dollar-euro. So that's one big driver for us. We do not expect central banks to come in. We actually, if anything, we're worried there's an investor confidence moment where people start questioning central banks. Yeah, they start questioning, and we see with Bank of Japan action recently and the impact on the Nikkei. The second one is, of course, the balance sheet expansion versus fiscal reform implementation. Now, the dream in Europe was that we would have seen a lot of ECB QE, then follow through by a lot of structural reforms. We've seen some of it, but I don't think we've seen enough to kind of fight the cyclical pressure we see on deflationary pressure or like structural changes in the global market. So we think as far as the ECB is considered, the desire to intervene is a bit overstated by the market. There is too much of a desire for a bailout. And more importantly, we think the willingness of the policymakers starting from ECB to test the banking resolution directive is very underestimated. The last point is about oil. Would we buy because oil is going up? If you think oil is going to go up, just buy oil or buy oil-related assets that have been crashed over the last few months. Now, we don't know what's going to happen with oil, but one thing which is certain to us is that if oil goes back to the 40, 45 level, God forbid 50, there will be a major, major impediment for a lot of central banks to keep on expanding or upgrade their expansion policy. Now, what is the kind of the end game? I mean, are we that naturally bearish? We think it's the end of the world? Absolutely not. We had this discussion with a lot of our investors. We think the next game is that we see, like we said a few months ago, we're going to see competitive QE, we're going to see a more aggressive tone, but eventually we're going to start getting into the third level, which is going to be debt reset. Debt reset in Europe could very well take the shape of bail-ins, of more bail-ins. Could be one option. It could be something else where we see more like of a pooling of resources for government bonds or changes in the government picture. It could be different things, but eventually we'll get a debt reset. By debt reset, a lot will be debt forgiveness offered by central banks. Now, to get there, we think we need a proper political support, and to get that political support, we need to see a proper set of negative events in the market before that happens. So within the end game, the positive end game is debt reset, debt reduction. It's particularly true for big macro blocks, US, Europe, Japan. It's not that available to a lot of emerging market countries, but for the big countries it will be available, but we think we'll get there. Before we get there, we need to go through some roller coaster in the market to create the political environment for that. What the other question the investors ask, and we personally ask ourselves every day, I mean, what if we're getting all wrong? What if we're getting dragged along into this sort of bearish view? What we are overestimating the bail-in or the implication of bail-ins in Europe? Now, we are setting a list of items that would force us to change our positioning. First of the list, as I said, is the backtracking on the BRRD rules, on the bail-in. That will be the big driver for us. The second one, of course, will be a material increase in ECB QE purchase. They actually go above and beyond the government bonds, either credit or bank risk. A lot of people expect them to announce buying of senior subordinated bonds. The other one will be a super long LTRO that allow banks to buy back their own debt. New evidence of growth globally. And then with that, a substantial and coordinated fiscal stimulus. And then last of the list, in terms of relevance, will be an oil spike. Now, oil spike, as we discussed previously, for us, will be good only short term, but long term, it will actually be a big negative driver. Now, on the other side, if we are correct, when is the right time to buy? I mean, now, if we are correct, I think we will see more bail-in. We will test the ability of funds to respect their liquidity commitment. And then with that, I think we need to see at least one or two flash crashes and some proper liquidation of funds for us to really think there's been a cathartic moment that we're going to go long. As of now, I don't see a compelling set of valuation, whether it is equity or banks or credit. We stay short. Yes, we delta hedge our exposure. We're not just outright short and static. And we use super liquid items to delta hedge our short exposure, but the structural short exposure, we keep them, and we're just trying to fine tune and trying to navigate through the squeezes. We always trying to make money out of squeezes as well, which is important. We're not trying to just be married to the view, but again, we stay very liquid, very opportunistic. We are ready to change. We're ready to move. And one thing that we keep on telling investors is like and that's why we keep on thinking, if this is like 2008, 2011, then guess what? We're going to have another 2009 or another 2012. Now, what is important for investors to know is that as we did in 2009, as we did in 2012, we are not shy to go long. I have no sentimental attachment to a bearish or bullish view at all. We are paid by you, by our investors, to preserve capital first and foremost, and then secondly, to make a positive return. And that's what we intend to do. And if that means say we're totally wrong, let's change and go long, we will do that. I hope the plan we have in mind actually develops the way we want, because then we'll be making money on the way down and then buy assets, and I think we'll find a lot of good assets available. But having said that, we are there to test our views and our commitment every day, and then we will change tactics if needed. Now, one thing that hopefully gives you some comfort for the use is definitely in 2012, but in 2009 the use was not around, but we had the hedge fund. In 2009 we made almost 200% of the capital on the hedge fund, and believe it or not, but we have all the data. We made that with only 50% of the fund invested across the year. The rest was unencumbered cash. Why? Because the opportunity was so great. Now, our view is that if we are even 50% right on what we're saying, we may see and the liquidity is there and investment banks are not there anymore. We will see an accelerated version of 2008, 2009 quite quickly. So that's what we're trying to be prepared for. We're trying to be very alert for, and that's one of the reasons why, unfortunately, we've been as glued as ever to the screen, and we need to keep on doing it. But I think the opportunity set is very, very attractive. It requires a lot of work and requires a lot of non-consensual positioning and very opportunistic, if you want, delta hedging of your view if and when needed. But I think the opportunity is probably one of the best we've seen over the last few years, and so we're very bullish on the opportunity set, and we think there's going to be great opportunity even more going forward in the next few months, next few quarters. With this, I conclude. Obviously, page 15 is a good, nice reminder from Edge Invest. There's plenty of information. You can go to Edge Invest or Nico's. You know, we have risk attribution report that goes all the way back to both for the usage to the inception. We can provide. We're always available to provide as much information as needed, and also for one-on-one conversation if needed. I leave it now. I conclude with this, and I leave it to you for any Q&A that you may have. Thanks.
Thank you so much, Filippo. Thank you. Like you, we are very worried about the liquidity in the credit space. That's why you are the only credit funds selected by our multi-manager team. So I have a couple of questions we received by email. One is about Banco Santo Spirito. You commented the situation, but please, can you provide us more details regarding the lawsuit? And second question is regarding non-performing loans. How is it realistic to imagine an European bad bank? What's your opinion? Thank you, Filippo.
Well, on the Novo Banco bond, I would distinguish between the bonds that were bailed in, including ours in December, from the one that were the one issued by Banco Spirito Santo that were bailing in August 14. Now, on the Novo Banco bond, as I said before, one of the hope we had was the ECB would have intervened to say that the interpretation of the law was way too extreme, and they would have blocked that. Not only they didn't do it, but they seemed to us they sort of endorse it. So that as a short-term trigger, positive trigger, is not going to happen. Having said that, we still think that the ground for a legal challenge is definitely there, and we think eventually will be won. It will take years, but if you look where the bonds are now, trending around 25, 26, and you think you're going to get probably, let's say, around par over the next 5 years, the risk return and the implied returns are pretty high. And those are, I would say, relatively uncorrelated with the market because it's pretty much a legal claim. Now, with that, as I said, we've been trading around it, and there's been instances when they went down to the 12, 13 level, we bought a little bit more, and then we sold them as high as 38. So it's a very volatile security. From a legal point of view, I think what they did is extreme because one big item to keep in mind here, one big difference is that what they did was subsequent to the proper bail-in and resolution of the bank that was done in August 14. And so the choice of those bonds where they want to concentrate the lawsuit was so arbitrary, so extreme, they will be definitely challenging court, and we think is violating a few principles inside the directive. So it will be challenged, I think, both in Portuguese court and European court. So we're quite comfortable that will happen, but it will be a very long long legal battle. We intend to hold the bonds as of now. We may take profit if they go above a certain level, but overall we think it's going to go on. And I think they're some of the best, most institutional investors, unfortunately, they were involved with this, as you can see from the press. And I think they're going to go on with the legal confrontation. And I think this, as opposed to other bail-in that could be done now, was also done in December 16. So it's even more difficult for them to justify certain treatment they've done at that time. So we're pretty comfortable on that, but I wouldn't hold our breath for something good anytime soon. So it will take probably a few months. It's not part of our sort of a business plan in terms of returns. On the other one, in terms of the bad bank on NPL, I think if we look at Italy, how tough it's been for them to get like a very small, very simple version of a national bad bank, I would say no, we don't think it's going to happen. We think it's much more likely that policymakers will be willing to test the implementation of the RRD in Europe, and maybe not just one, maybe probably 2 to 3 jurisdictions where they would do it. And as I said, if they do it and then the split between retail and institution is evident and so becomes clearly part of policy, they would have major repercussions in terms of pricing of security and pricing of capital markets in Europe. Our view is that the same way they've done capital controls in Greece and Cyprus, the same way they've done the bail-in with Novo Banco, the same way they've done it with the Italian banks with the bad bank now, is that at the end of the day, the European policymakers are willing to take risk and they're willing to test the market. They've done the new rules, they've done the new system. Remember, you heard it many times and we probably forgot about it, but one of the reasons why they did the bailout before was because they didn't have an alternative. It's not because they wanted to do it, it's because they had to do it. And if you remember, and Schäuble said it many times, we could not do otherwise, but now we have the SM, we have the OMT, we have the QE, we have the BRRD, we have a lot of institutions that have been created in Europe, and policymakers will use them. To think Draghi is going to come and bail us out and buy all the banks because he doesn't want to do bail-in, I think is madness. So we are very convinced that policymakers will test the market, and so far, and people like to complain about policymakers, they don't think they're professional, they don't think they're smart. I personally think Draghi is better than and smarter and more equipped in terms of intellectual capital at the ECB than most of the best hedge fund managers out there. So one thing that you cannot underestimate is that policymakers have been taking an increasing amount of risk in Europe, and so far they got it right. Remember, when they introduced capital controls in Cyprus, people thought that was the end of the euro. And look what happened. 2 years later, they've done it again with Greece. So let's not underestimate. These guys didn't approve a massive body of new legislation to just say, oh, sorry, we got it wrong, we're going to cancel it. They got it, and they're going to use it. And let's not also forget that all the statements we've seen coming from Germany, Finland, but also France, at the end of the day, when they talk about banking union, they always say we will introduce the wide European deposit insurance scheme if and when we have a level playing field. A level playing field means banks are sort of capitalized or they got an asset quality which is roughly comparable across different jurisdictions. And we're not there yet. So we think we're going to see more bail-in than bad banks, that's for sure. I hope he answered the question.
Thank you, Filippo.
Any other questions?
Excuse me, this is the Chorus Call conference operator. We will now begin the question and answer session. The first question is from Akshay Shah from GSO. Please go ahead.
Hi, Filippo. Good morning, and thanks for hosting this. First of all, congratulations on the very good performance of the last several months. I think on page 3 or 4, you spoke about the negative feedback loop, the technical dynamics creating a negative spiral here. For the longest time, we had a positive feedback loop. What in your mind are the one of many factors that resulted in that positive loop now becoming a negative loop?
Thank you. It's always difficult to say. I think one of the biggest issue is investor confidence, and then, as you know better than me, it's got very little to do with rationality, but more sentiment. And I think one issue is central bank's behavior, right? Because the reason why everybody made money from 2009 onwards was because we're long. It didn't matter what you were long. Whatever you go long went up, and so you made money. Now, you fast forward to now, and you look at central banks, you feel like, they're not really getting anything right better than the others in terms of forecast. They didn't get the oil secondary effect right. They didn't do this and that. But also, more importantly, it seems to me now, with the Fed moving away from additional QE, and then Bank of Japan and ECB trying to emphasize more negative rate and balance sheet usage, that start creating a bit of doubt. Yeah, I mean, at the end of the day, the positive loop is because there were more buyers than sellers, and more buyers was central banks. Now, if these guys start kind of withdrawing, although gradually from that, the market may get a little bit nervous, and then it will become a bit of a musical chair kind of game, and you want to get out before it's too late. The other issue, which I think is something we all study at university, if oil goes down is good because it's a big boost for is a good supply shock. That, unfortunately, I think is, because it's not happening, I think a lot of investors are asking themselves, is there any structural reason behind? Are we really in a structurally different world where we don't need 7 billion people to cater the need to 7 billion people? And that's a big, big question mark. And I think there are too many of those coming up. So I think we're moving away from the super positive loop that we had before. And I think there are quite a few things happening there. And then on top of that, unfortunately, you have the electoral political cycle, which is creating a totally new volatility input, which is super difficult to estimate. I mean, no matter how many polls you're going to read on the UK referendum, you will never be safe until the 24th of June when you know the results. So, and I think it's kind of perverse. We're seeing on one side, we're seeing a lot more issues and problems in the financial market. On the other side, we're seeing politically, and probably rightly so, I'm not questioning, but we're seeing actually a trend to move to actually ask the electorate more frequently and on more items. And that, the combination of the two, I don't think is going to be particularly great for financial stability in the short term.
Thank you.
Thank you.
As the next question is from Nikos Kargadouris of Numen. Please go ahead.
Hi, Filippo. Thank you very much for the presentation. Just a quick question. In terms of the upcoming ECB meeting, can you shed some light on sort of what Numen's base case is? I know I've had quite a few investors asking what, if anything, can the ECB do, assuming that markets stay sort of where they are at the moment? Thank you.
Thanks, Nico. We had that question with a lot of investors. It's actually a very good question. Our view at the end of the day, two things. If the market recovers a lot, like it seems to be doing now, into the ECB, and it's sort of price ECB too much, we may have a bit of another January effect. So they price too much into the action, and the action is actually disappointing. So that would be my sort of a risk management approach, as in, if we go up too much, probably is a short. If we stay down or go down, probably it's trying to cover some of the short. So having said that, I think the items they need to go through is, one, what they're going to do with negative rates. I think they're probably going to bring negative rates down. That's our base case. The question is, if they do too much, what is the impact? If they do too much, I think they're clearly opening the warm can of currency wars. If they start bringing negative rates by more than 10, 15 basis points on top of what they've done, I think it starts becoming a big confrontation and becomes difficult to manage for China, for Japan. It could accelerate meaningfully. Now, if you remember, that's our kind of, that has been our consistent view over the last few months. We expect competitive QE, which means negative rate, because that's the one that affects currency straight away. The real issue is what they do with the asset buying program. are they going to buy more Govi? Yes or no? And then secondly, are they going to buy other assets? Yes or no? Now, my base case, they would increase a little bit the Govi bond, but they're not going to go into other asset classes right now. The third item, which I think will be probably the most interesting for us, is again what they say about bail-in. And if they continue with and I doubt Draghi can say anything different from what he said at the European Parliament. Now, that will be another big driver for me. Now, in terms of their buying, of course, the market could be very positively impacted. Now, the worst case scenario for the market is that they do negative rate, but they don't touch government bond. They don't increase. Now, if that happens, it means politically ECB already moved. I mean, our view is that Draghi this time is very much sided with the Germans. They want to do bail-ins. They don't want to help periphery or banks right now because they can't trust them politically. That's my personal view. There's a big gap between the political alignment of the ECB and the politician and the governments. So it depends. Our base case, they do negative rates and maybe add a little bit of government, but the worst case scenario, if we only do negative rates for the market and they don't touch government bonds, then I think would make like we've seen in the slide, one of the first slides, we'll see the super risk-free assets performing very, very, very well. And then the rest will start really drifting because you get a sense that the central bank does not want to take credit risk anymore, which I think will be a disastrous message to the market. So given where the market is, they definitely need to do asset buying. We think there's a chance to do 5 to 10 billion more a month, maybe, but it's a big question mark, and I think it will be very much, very closely watched. Now, the worst thing again for the market is that no matter what it does, if we have a repeat to what we had with Bank of Japan negative rate, the market buys the first few hours and then sells off, then I think again, like we're gonna have the kind of negative feedback loop very quickly. Any other question? And
Mr. Bestetti, Mr. Lanza, there are no more questions registered at this time.
Okay, thank you, Filippo, for the conference call, for your time. And if you have other questions, please send me or to Nico question by email, and we can answer you. Okay, thank you.
Thank you very much. Thanks, everybody. Thank you. Bye-bye.